Hello, everyone. This is Zak Gardezy. I'm the host of Money Minutes. I'm also the founder of Wealthstone Private Wealth Management and a certified financial planner. So, here on Money Minutes, I'd like to share with you some of the latest market updates and my thoughts on what's happening in the overall economy and markets. So, on this week's episode, I'm coming to you live from Paris, France, where I'm enjoying some time away and also enjoying this beautiful city. But I wanted to make sure that I brought this update to you all because there's some exciting things happening in the market, and I wanted to make sure that Wealthstone clients and those who check out our videos on a weekly basis stay updated. And so let's get right into it. Okay, so there's a lot of interesting things happening in the market. So first of all, the market went through a pretty serious correction over the last couple of weeks. There was all sorts of doom and gloom, and I know I talked about it over the last 2 weeks on Money Minutes episodes. We've talked extensively around emotional portfolio management, right? Panic selling and avoiding, just really the doom and gloom news and headlines that you hear about. We're heading into a recession, the market's going to crash, it's going to be the worst crash ever. I mean, there's all sorts of scary things that you read about. And what I like to tell clients is just try and not pay attention to the headlines in the news that comes out during those types of, moments. A lot of it, especially nowadays, it's a bunch of clickbait where they try and get you to click onto the article so they can generate ad revenue or, whatever it is, the type of money they make from getting you to click onto their articles. So they say the most outlandish things when really a lot of this stuff is pretty common. Like we've talked about market corrections, they happen almost every year. And so we went through a market correction, and remember, even during the market correction, the S&P 500 was still up double digits for the year, which is above average when we take a look, over the last 100 years, for example. And so it was a pretty scary time, albeit, but as I reminded clients and still do, we're going to have lots of volatility in the second half of the year. Now, the important news, coming out of the economy is inflation. So we just got a CPI report that shows inflation's at 2.9%, which is the lowest reading we've got since 2021. And if you couple that with the labor market data, remember, the labor market is showing significant signs of slowing down. That is a risk to the economy, and the Fed's going to be concerned about it because that could lead to a recession. And so the solution that we think, right, from a weakening labor market is to stimulate the economy. Remember, when the Fed in 2022 and 2023 raised interest rates, that was to try and slow down the economy and to try and slow down inflation. Well, now we're on the opposite end of this deal where the economy is slowing down a lot, so much so that the labor market is starting to struggle. And at a certain point, the Fed has to try and stimulate the economy again to avoid dragging us into a recession. It's really a balancing act because, for example, in 2022, many thought the Fed was late and they should have raised interest rates a lot sooner, right, to try and avoid all of that inflation. And now the concern is, will the Fed cut rates on time, or will they be late, or are they already late to doing that? And so, let's take a look at, for example, the September meeting that's happening on September 17th and 18th, the FOMC, where the Federal Reserve gets together and decides what they're going to do with interest rates. The expectation at this point is basically a resounding yes, we're going to get interest rate cuts. What's up for debate is how much. Are we getting 25 basis points or 50 basis points lower? And JP Morgan analysts, as an example, they think that we'll get a 50 basis point cut in September, 50 basis points in November, and 25 in December. That's pretty significant because that's more than what we were thinking back when the market was hitting its all-time highs. And remember, interest rate cuts are typically a catalyst for the market. And so if now we're getting to a point where the market's really recovered quite a bit, it's up over 17% now on the S&P 500. So we've recovered a lot of those losses, still some room to go. But if we're going to get more cuts than expected and we could stave off a recession, I actually am putting this at a more bull side of the S&P 500 scenarios where we're going to potentially hit some of those higher levels. I think we'll definitely be over 5,700 for the year on the S&P. That puts us at above average and really a great year for the market. Now, the key there is the Fed has to stimulate the market. They have to do a good job. They have to avoid a recession. And we have to avoid some of these geopolitical risks, which I think are the biggest concerns right now. The tensions between Iran and Israel that could boil into a regional conflict. We've talked about what that could do with oil prices and potential global recessions. And we're also seeing now with Ukraine and Russia a significant increase in escalation of tensions there, where you've got Ukraine now in Russian territory taking land, and the Russians are having a tough time with that battle. And so that could potentially turn it into something more larger, unfortunately, right? The Russians could potentially, they've talked about their red line is attacking within Russia, which would then give them their justification for using tactical nuclear weapons. I mean, that could be a huge escalation, something that I don't expect Russia to do, but you just never know with geopolitical things. And so that's why I continue to avoid direct investments in the international markets for Wealthstone clients. I'm still bullish on the U.S. market, and so although the markets and the economy are showing us some really good signs and some tailwinds that we should probably look at, putting some cash and some money market funds to work, I do still think there are some risks out there that we should be aware of. So we should, of course, as always, invest wisely in the markets. But nonetheless, if I had to sort of put it all and wrap it all together in terms of what's happened over the last few weeks, we had some scary, market correction come out. A lot of things happened at once, whether it was geopolitical, domestic politics, the economy, fears of a recession, the labor market really dropping like a rock. I mean, so much happened at once. It was very, a volatile time, and that's exactly what we saw. We saw the volatility index go up dramatically. But as I've talked about, a lot of those things are going to dissipate. The headlines are going to clear, and we're going to figure out exactly where we're at. And now we're seeing we've got interest rate cuts around the corner. That's a tailwind. And we've got potentially a soft landing that I still think is on the table. And so lots of good news. I'm very optimistic still about what's happening in the market, still very optimistic about AI. Excited to hear what NVIDIA has to say on August 28th when they report earnings. They do have really a make or break earnings report for the market as mega cap tech and AI continues to dominate the S&P 500. And so a lot of good things to talk about over the next few weeks as I continue to bring you more episodes of Money Minutes. But as always, if you have any questions, please don't hesitate to reach out. This concludes this week's episode. I'll see you all again next week. Thank you very much.